September 2024, the business produces and sells a single product branded K, whose details are provided below. So we are given the direct material, which is shillings 5 per unit, the direct labor, which is 10 shillings per unit, the variable overhead 6 shillings per unit, the selling price is 40 shillings. So we are given additional information, projected sales and the production units. Information is provided as follows. So in our case here, we are given the projected sales in units from the month of July all the way to the month of December, all the way to the month of December. These are the units which the company projects it will be able to sell. And then you're given the production. So these are the units which are the company projects it will be able to produce. And then from there, we are given the variable overheads. And the variable overheads are paid in the month that they are incurred. And then you're told the fixed overheads are budgeted at shilling 700,000 per month, which include the depreciation. Remember, we say that depreciation, this one is an non-cash item, So when preparing the cash budget, we don't consider the non-cash item. In other terms, we don't consider those particular items of incomes or expenses which do not give rise to a cash inflow or cash outflow. So in our case, when considering these fixed overheads, we will have to exclude the depreciation simply because it's an non-cash items. And then number 4, we are told wages are paid 75% during the month in which they are incurred or basically earned, that is, and 25% in the following month. Number 5, material costs are paid 2 months in arrears. So in other terms, the material will be paid after 2 months, in arrears. Number 6, a tax liability of 1.4 million to be settled in the month of October. 7, a new van will be purchased in the month of September 2024 for shillings 2 million. And then you're told the current motor vehicle shall be sold in the month of November 2024, and it is expected to fetch shillings 300,000 from a prospective buyer. And then number 8, we are told the cash balances at the month of August 2024 is expected to be 1 million. And specifically, we are told that this is the cash balance at the end of the month of August. Automatically, this cash balance at the end of the month of August shall be the opening balance in the month of what? In the month of September. In the month of September there. And then you're told the business makes a monthly cash sales of 50% of the total sales in a specific month, while the remainder is on the credit, which is settled 1 month after the sales. So what are we required to do? We are required to prepare the cash budget for the month commencing 1st September 2024 to 31st of December 2024. In other terms, you're required to prepare the cash budget for how many months? The month of September, the month of October, November, and December. So that is a cash budget for how many months? For 4 months. For 4 what? Months. So maybe in this case, I don't know whether we have some few workings we need to do here before even we can proceed to prepare our cash budget. Let's see whether we see whether we have some few workings which we need to do before we can proceed to prepare the cash budget. But remember, in this case, we said that the first thing you should even be able to remember is the format of the cash budget. Remember, you said when preparing the cash budget, always we have the details column, and basically columns equal to the number of months. If you can remember the question which we did in class, we prepared the cash budget basically for 12 months from January all the way to December. But in this case, we're required to prepare cash budget just for 4 months. The month of September, October, November, and December. So we need to have basically how many columns? 5. The total, the details column, and basically columns equal to the number of months. And then from there, we start by recording the opening cash balance. We record the cash receipt or the cash inflows. And then after that, we record the cash the cash outflows. So maybe we can see which expenses or maybe which workings we can compute. Now here, we are told this company, which is called 𝐻𝐻𝐿, basically produces and sell a single product, which is called a product K, and we are given the details. So these are basically the production costs. So for the company to be able to produce that product, the company incur direct material cost, direct labor, variable overheads, and the selling price. Maybe in this case, we can have some few workings here. We can have some few workings even before we proceed to prepare what is required. Maybe we can start by computing this particular variable cost, because in this case, I think in point 2, we are told variable overheads are paid in the month they are incurred. Which are the variable costs? The variable costs are basically this cost which we have here, the direct material, direct labor, and the variable overhead. So I think what we need to do is we compute the variable overheads. Let's have that as the first working here. As the first working here, the variable, the variable overheads. Or I don't know whether we, instead of having that here, can we have that working within our cash budget? Yes, let's do that. Instead of having separate working, because remember you said this particular working, for example, in an examination setup, will just be consuming a lot of your time, but basically by the end of the day, they are not marked. So maybe I can have that figure here. The direct material cost is 5 shillings, and then the direct labor cost will be 10 shillings, 10 shillings, and then in this case, the variable overheads will be what, 6 shillings, and then the selling price will be 40. So any working which basically is required, we are going to do it per need basis. We are going to do it per need what basis. Maybe first of all, let's come up with the format of our cash budget. I can basically borrow this one here. I copy. So we require to prepare the cash budget. We require to prepare the cash budget here. The cash budget for the month of September all the way to December. So I'll basically be able to copy all these months. I'll copy all this, and then I'll have them here. So I'll basically paste. So those are basically our 4 months, September all the way to December. So what do we start with here? We always start by recording the opening cash balance, Then below that, we record what? The cash receipt. I hope you can be able to remember this. The cash receipt, in other terms, is said that this can also be known as the cash inflows. The cash what? Inflows. The cash which is flowing into the business. Cash flowing into the business. And then down here, I will have the cash payments. Yes, maybe I think that space is enough. I'll have the cash payments. Cash payment. So the cash payment, in other terms, we also refer to this as what? The cash outflows. The cash outflows. Yes, equally in this case, we can also be able to bold this one. Yes. So I think we can go straight to this information which we have in note number 1. Note number 1, we are basically given the projected sales, or the sales, or the units which were expected to be produced and sold. So this one will help us in terms of computing a number of items down here. I think we can start with the note 2. Variable overheads are paid in the month which they are incurred. The variable overheads basically, I've said, are these 3 costs here: the direct material, the direct labor, and the variable overhead. So what I will do, I'll basically copy all these, because these are variable overheads, or the variable costs. So I'll copy all this. I basically bring that here. Remember, once the company pay for some expenses or some overheads, that is a cash payment. I'll basically have that here. I'll paste that here. Okay, so let me redo that afresh. I'll copy Control C, and then I paste it here. Huh? What is happening? What is happening here? Okay, so let me copy. I don't know why this one is not moving. I copy and then I paste it here. Okay, let me copy this one. I see whether it will be able to move. Okay, let me first of all maybe move it to, I arrange this on the right. National Accounting Standard Number 21, IS 21, overseas or basically a foreign subsidiary. So first of all, we need to ask ourselves here, what is an overseas or basically what is a foreign subsidiary? So this basically a subsidiary which is operating in a country different from the parent company countries of operation. Like in this case, we may be told that a company which operates in Kenya has acquired a subsidiary which is either operating in Uganda, in TZ, or maybe like in Rwanda. So that particular subsidiary is operating in a different country from the parent company countries of what? Of operation. So such a subsidiary, we refer to it as an overseas or basically a foreign what? A subsidiary. So therefore, this is basically a subsidiary company, a subsidiary company which is operating in a country, different from the parent company country of operation. Country of what? Of operation. Country of operation. For example, in this case, we may be told that a company which is operating in Kenya basically has acquired a subsidiary, which is, for example, operating in what? In Rwanda. So the parent company operating in Kenya, the subsidiary is operating in what? In Rwanda. So this is basically a foreign or basically overseas what? A subsidiary. Now, in this case, how do we prepare the group account here? The first thing which is important for us to appreciate here is that the Kenyan currency basically is the Kenyan shillings. What is the name of the currency for Rwanda? The currency for Rwanda is known as what? Who can tell us here? The currency for Rwanda. The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda. So the currency for Rwanda is known as Rwandan franc. Is known as what? Rwandan franc. Just like if you go to TZ, their currency is Tanzania shillings. If you go to Uganda, their currency is Ugandan shillings. If you go to Rwanda, they use a currency known as Rwandan franc. Rwandan franc. So basically, you can see that these two companies here, they basically prepare their financial statement using a different currency, using a different what? A currency. So this one, the parent company prepares financial statement using the Kenyan shilling, this one using the Rwandan franc. It is obvious that if you are preparing the group accounts, there is no way you can do a direct consolidation. You can do a direct consolidation. You take the asset and liabilities, revenue and expenses of the two companies, you combine them. You can't do that because you can see those currencies are different. The financial statements of the parent company is prepared in Kenyan shillings, and the financial statements of the subsidiary are prepared in what? In Rwandan franc. So in this case, we are going to look on how do we translate, how do we do the translation. But even before we do that, we look on that, and maybe there are some two terms we need to define here. One is something called a presentation currency, and also something called the functional currency. The functional currency. So when talk about the presentation currency, this is basically the currency which is used by the parent company in preparing the group account. The currency used by the parent company, to prepare the group accounts, to prepare the group what? Account. In most of the cases, if the parent company is a Kenyan company, this one will be preparing the group account in Kenyan shillings. If the parent company is a Kenyan what? Company, it will be preparing the group account using the Kenyan what? Shillings. But that currency used by the parent company to prepare the group account is called the presentation currency. On the other hand, we talk about the functional currency. The functional currency, this is basically the currency, the currency of the primary economic environment, in which a company operates, in which a company operates, in which a company do what? Operates. So basically that local currency of the country in which the company operates. So if the parent company is operating in Kenya, the functional currency is Kenyan shillings. If the subsidiary is operating in Rwanda, the functional currency or the local currency for that country is Rwandan what? Is Rwandan franc. So therefore, in this case, when preparing now the group accounts, we are saying, before you proceed basically to do the consolidation, before you proceed to add assets, liabilities, revenue, and expenses, those of the parent company, this particular foreign subsidiary, it is important for the financial statements of the foreign subsidiary to be translated into the presentation currency. Into the presentation what? Currency. Remember, you said the presentation currency is that particular currency which will be used by the parent company in preparing the group account. If the parent company is operating in Kenya, it will prepare the group account using what? The Kenyan shilling. So therefore, before we combine similar items of asset, liabilities, revenue, and expenses, those of the parent company, those of the foreign subsidiary, asset, liabilities, revenue, and expenses of this company, that is the foreign subsidiary, must be translated into Kenyan shillings, which is the presentation code, a currency. So how do we do the translation? These are the translation rules. These are the translation rules. These are the translation rules. And this basically what is very, very important you need to remember. Number one, when translating the items of incomes and expenses, items of incomes and expenses, and remember in this case what we are translating are the incomes and expenses of this foreign subsidiary. So we translate them, they are translated, items of incomes and expenses are translated using something called the average exchange rate. The average exchange what? The average exchange rate. Because in most of this particular question for foreign subsidiary, you'll be given usually 3 exchange rates. You'll be given the exchange rate at the start of the year, the exchange rate at the end of the year, and also will be given the average. So in this case, we translate incomes and expenses of this foreign subsidiary using what? Using the average exchange rate. The average exchange rate. Number 2, when translating the asset and liabilities, the asset and liabilities of the foreign subsidiary into a presentation currency, these ones are translated using the crossing exchange rate. The crossing exchange rate. This is actually the exchange rate at the end of the year. The exchange rate at the end of what? Of the year. So if you're able basically to know that, then this particular question, or the question for preparation of group accounts whereby we have a foreign subsidiary, they become very, very simple. But it is obvious that in the process of translating the assets, liabilities, revenue, and expenses of this foreign subsidiary into a presentation currency, there is something which is known as the translation, or basically yes, the translation currency difference, or can we just refer to it as the exchange difference? Exchange difference. In other terms, we refer to this as the currency translation difference. Translation difference. Currency translation difference is basically an exchange difference which arises from translating the items of asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference or this exchange difference can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises due to translation. This arises due to translation of basically 3 items. One of which is goodwill. Is goodwill on acquisition. Number 2 is a profit for the year. And number 3, the subsidiary company opening net assets. So opening net assets. Opening net what? Assets. So we are saying that this currency translation difference which arises as a result of translating the items of asset, liabilities, revenue, and expenses into presentation currency. It basically arises from the translation of those three items, the translation of those three items. So I want us to look on how we determine this currency translation difference, which basically arises from translation of those three items, the goodwill, profit for the year, and the opening net asset of the subsidiary. So let's start with the goodwill. The goodwill. So remember, goodwill, this is the difference between the purchase consideration paid by the parent company and the net asset which were acquired. So basically, what is important, first of all, to note here is that when computing the goodwill, first of all, we compute the goodwill, or basically we say that goodwill is computed using the fractional currency, using the fractional. The fractional, remember, is the local currency. For example, the local currency of Kenya is Kenyan shillings. The local currency of Rwanda is Rwandan franc. So first of all, we compute the goodwill using the goodwill is computed using the fractional or the local currency of the foreign subsidiary of the foreign subsidiary. So if the foreign subsidiary is operating in Rwanda, what you do when computing the goodwill, first of all, compute the goodwill in Rwandan franc. You compute the goodwill in Rwandan franc, not in Kenyan shillings. Compute that using Rwandan franc, and then translate it, into presentation currency. Translate that into presentation what? Currency. So compute that goodwill using the functional or the local currency of the foreign subsidiary, then translate that into presentation currency. In the process of doing that, we have an exchange difference. How do we compute that exchange difference? I want us to look on how we compute the exchange difference arising from the translation of goodwill, goodwill. So basically, for us to be able to look on how we determine this, we need to have like a number of columns here. So here we have, in this case, I will assume our parent company operates in Kenya, but the foreign subsidiary operates in what? In Rwanda. So here we will have now the local currency of the foreign subsidiary, assuming it is Rwandan franc. This is basically the local currency of the foreign subsidiary. We have a column here for the rate of exchange. The rate of exchange. You'll be given the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate, and then here we translate that into presentation currency, which is the Kenyan shilling. So here we always start with the goodwill on acquisition. The goodwill at the date of acquisition. You'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the fractional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, or for opening, the opening exchange rate, the exchange rate at the start of the year. We get the value there. And then out of this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average. And then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that, and basically you read one line here. That now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year, and that is the date we are doing our consolidation. Remember, doc is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then we take this particular goodwill, we translate it now into presentation currency. And in this case here, because it's an item of assets, and we are translating that at the end of the year, now we have to use which exchange rate? We use the closing exchange rate. We take this, we translate it into presentation currency using the closing exchange rate. We get the value there. The value there. Then for us to be able now to compute this exchange difference, what we do is that we compare the value which we will have gotten here, this one with this one. So we compare these two values here. We compare these two values, this and this, of which in this case we can have an increase. Maybe from this to this, we can have an increase. Or basically from this to this, we can have what? A decrease. We can have a decrease. So that increase or decrease is what you refer to as exchange difference. And this exchange difference can either be an exchange gain or an exchange what? Loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease, like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, this exchange gain or loss, this one will be recognized in the consolidated income statement. In the consolidated income statement as part of other comprehensive incomes. Will be recognized in the consolidated income statement as part of other comprehensive incomes, part of other comprehensive incomes. So we know other comprehensive incomes, we add this to the gross profit. Not to the gross profit, sorry, we add this to the profit for the year, to the profit for what? For the year. So that's basically how we compute the exchange difference or the currency translation difference, which arises from the translation of what? Of goodwill. Translation of a goodwill. So then from there, I want us to look on how we compute the exchange difference arising from translation of these two items. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary, opening net asset of the subsidiary. This one is computed. We compute the exchange difference together here for those two items. The exchange difference on translation of those two items. So here we need to have the same columns. The local currency of the foreign subsidiary, the exchange rate, and the presentation currency. So always here we start with the opening net asset. The opening net asset. These, in other terms, are the net asset of the subsidiary on the date it was acquired. Remember, we have said in all these questions for foreign subsidiary, our foreign subsidiary will have been acquired at the start of the year. So take the opening net asset. The opening net asset on the date of acquisition in in local currency, for example, rand and franc. Translate that into Kenyan shillings using the opening exchange rate. You get the value there. And then to this, you add the profit for the year. The profit for the year. And remember, this is the profit for the year for the subsidiary. In case there is some adjustment affecting or which should be affected in the income statement of the subsidiary, like a depreciation, other charge, maybe something like amortization, which was not accounted for by the foreign subsidiary as a result of fair value adjustment. Remember, we said whenever the subsidiary has been acquired, the subsidiary can devalue assets, like maybe item of PPE or even things like intangible assets, like maybe brand or something like that. So if the foreign subsidiary devalued some assets, automatically it's never accounted for that. So if it is an item of PP, you have to compute the depreciation other charge. You are adjusted to this profit. If maybe it revalued an intangible asset like brand, compute the amortization adjusted to this. So you have the adjusted profit for the year. And because these are profit, you translate it into this into presentation currency using which exchange rate? Using the average exchange rate. Using the average exchange rate. The average exchange what? The average exchange rate. And then basically what we do down here, you leave two lines there. What we will have here is the closing net assets. the closing net asset of the subsidiary. We translate that now into presentation currency using the closing exchange rate. Using the closing exchange rate, we get now the translated value there. And then we take this plus this, and basically we compare these two. We compare this with that, just like what we have done down here. So the difference which you get here is what is known as the exchange difference, or actually this one would be the exchange gain, or the exchange what? Loss. So if from this to this, remember this net asset. So just like goodwill. So if from this to this we have an increase, is an exchange gain. If we have a decrease, is an exchange what? Is an exchange loss. Is an exchange loss. And equally now this one will be recognized within the consolidated statement of profit or loss, or the consolidated income statement as part of other comprehensive what? Other comprehensive incomes will be recognized there as part of the other comprehensive incomes. So basically, this is how we compute the exchange difference. That is the exchange gain or loss arising from the translation of the various items of asset, liabilities, revenue, and expenses of the foreign subsidiary, of the foreign what? Subsidiary. So once you come across this particular question for foreign subsidiary, usually maybe in Roman 1 of the question, the examiner will require to compute this. The exchange difference or the currency translation difference arising from the translation of goodwill and also the profit for the year and the opening net asset. That's basically how you do that computation. Roman 2, then you'll be Roman 2, Roman 3, you'll be required to prepare consolidated income statement, consolidated statement of financial position. I'll say for you to prepare number 1, the consolidated income statement. So before you even, or basically when combining the revenue and expenses of the parent and that of the subsidiary, you'll take that of the parent, which is already in presentation currency, but you have to translate that of the subsidiary. We have said that all these items of the subsidiary will be translated using the average. All items of the income statement will be translated using the average exchange rate. But the items of asset and liabilities, those of the foreign subsidiary, will be translated using the closing exchange rate. Closing exchange rate. So if you can be able to record that, basically this one is quite simple. Quite simple. And I think with that particular knowledge, I want us to go straight to a question. We go straight to a question on a foreign subsidiary. On foreign subsidiary. Usually, this is one of the areas which is very simple. You'll be able to do that. You'll be able to see that. One of the areas which is very simple. Very simple. Yes. I want us to do a question with both the income statement and the statement of financial position. And basically the question I want us to start with. Yes, so let's start with this one. April 2022. Which is the question number 1. Question number one. April 2022. So if you're there, you can just confirm. Yes, are you there? Are you there? Okay, okay. So what are we told here? What are we told? What are we told here? We're told that P Limited is a public limited company listed in the Securities Exchange. Listed in the Securities Exchange. It has diversified its activities by acquiring S Limited, a company domiciled in a foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is Kenyan shillings, while S Limited functional currency is franc. Remember, I've explained what is the meaning of those two currencies. Presentation currency is the currency used by the parent company to prepare the group accounts. We are told is Kenyan shillings. But now, this foreign subsidiary, which is S Limited, it operates, we are told, is domiciled in a foreign country. Its functional currency, the local currency of that foreign country is franc, which is denoted by FR. Financial statement for the year, which ended 31st of December 2021, and set out below. So we're given the statement of profit or loss for the parent and that for S. You can see the statement of profit or loss for the parent company is in Kenyan shillings, but that of the foreign subsidiary is in franc. That's why I say, if, for example, now you're preparing the consolidated statement of financial position, there is no way you can do direct translation. Sorry, direct consolidation. That is direct consolidation. You take the revenue and expenses of the parent, you add with that of the subsidiary. You can't do that because you can see those that statement of profit or loss of the parent, that of the subsidiary are in different currency. That's why we are saying even before you do the translation, we translate those items of the foreign subsidiary into presentation currency, which is Kenyan shillings. So then from there we have the statement of financial position for the two companies, P and S. Equally, you can see the statement of financial position of the parent is in Kenyan shillings, that of the foreign subsidiary is in franc. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have addition to note number 5. What are we required to do here? We are required to determine the exchange difference, which is basically the gain or loss arising from the retranslation, or basically arising from the translation of the net assets and the goodwill on acquisition of the foreign. Part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 31st of December 2021. And then from there, we are required to prepare the consolidated statement of financial position. So before we even do that, I want us, we come up with a group structure. Let's come up with a group structure. Group structure. And the group structure. So where do we have information about the group structure? We have that information in note number 1. Let's go to note number 1. In note number 1, you're told on 1st of January 2021, the company which is called P Limited acquired 80% of S Limited, 1 million, 1 franc ordinary shares for a cash consideration of 35.50 million franc. So this company acquired S Limited, and basically this S Limited, remember, we are told is domiciled in a foreign country. Is domiciled in a foreign country. Is domiciled in a foreign country. In other terms, is a foreign subsidiary. In other terms, is a foreign subsidiary. Yes. So in this case, we have the parent company and basically the foreign subsidiary. As per that note, we are told the acquisition took place on 1st of January 2021. So that is the date of acquisition. Remember, I said in all these particular questions for foreign subsidiary, usually the subsidiary is acquired exactly at the start. So it was acquired on 1st January 2021. That is the date of acquisition. When are we required to prepare the group account? The date of consolidation, though. So in the requirement, specifically in Roman Part B and Part C, we're required to prepare the group account for the year which ended 31st of December 2021. You can see our subsidiary was acquired exactly at the start of the year. Sasa, yes, we say it's always important for you to note the date of acquisition. So we have that information there. That is the group structure. P is a parent, S is a foreign subsidiary. Now, in that case, we are given the purchase consideration which was paid, which was 35.50, and actually this is in franc. Then no working which is required there, but we are going to use that information in computation of goodwill. In part B, also not part B, rather note 2, we are told at the acquisition date, the carrying value of S Limited net asset was 2,600 million franc, but the fair value was 3,200 million. In other terms, this company revalued the assets. On the date of acquisition, revalued its net asset. We are told the net asset had a fair value of 3,200 million franc, and the carrying amount of this net asset was 2,600 million. So it basically means that in this case, we have an increase in the value of the asset by 600, which automatically is the valuation what? Gain, is the valuation gain. So, and then you're told the excess in the fair value of the carrying amount was due to unrecognized branch with a remaining useful price of 5 years at the date of acquisition. So we are told this revaluation gain is due to a brand. In this case, a brand is basically a form of a brand is a form of a trademark. In other terms, a brand, this is a form of an intangible asset. This is a form of an intangible asset. Just like the other question we did, whereby we were told that the subsidiary on the date of acquisition valued, or basically there was a list of customers which was not yet recognized. And we say that list of customers should be recognized as what? As an intangible asset. The same case with this particular brand. So what is the value for the brand? So the unrecognized brand. Unrecognized brand. And basically we are saying that this unrecognized brand, this is a form of an intangible asset. A form of an intangible asset. So the value for this brand would be the difference here. It will be equal to 200 million franc minus 26. This will be 600, or this will be 600 million franc. Remember, this particular asset here was revalued on the date of acquisition. So how are we going to account for this amount here? This amount of 600. So this amount of 600, number one, this one will be recognized as an intangible asset. As an intangible asset within the consolidated statement of financial position is an intangible asset. Number two, this one is a pre-acquisition revaluation reserve. Is a pre-acquisition revaluation what? Reserve. So that's the first thing you need to know. And then in the same point, we are told that this particular brand had a remaining economic useful price for 5 years at the date of acquisition. Remember, I think in most of the questions which you have done, we were told the item which was revalued was an item of PP. What we were doing, we were computing the depreciation at the charge. In this case, do we depreciate intangible assets? No, we amortize. So what we need to do here is basically we compute the amortization, because what we say is that once the subsidiary company has revalued the asset, the subsidiary company do not account for that revaluation. So what we need to do is to compute the amortization for this brand. The amortization, we compute this using the same formula we were using to compute the depreciation at the charge. We take the revaluation gain for the value at which the asset was revalued at. We divide that with the remaining useful price or economic price. And I think we are told the remaining economic or useful price in note number 2 was 5 years. 5 years, we divide that with 5, and then we should multiply that with the proportion of time. The proportion of time is the time we have between these two dates. In this case, we have 1 year. So we are interested with amortization for just 1 year. For just 1 year. So this will give us what? This will give us 120 million. And it is also important for you to note that this 120 million, this is still in franc. This is Yes, are you there? Do you have the question with you? If yes, please confirm. Please confirm, please confirm. I can see we have 1 hour, 20 minutes. We must finish this particular question here. We must finish that question. Okay, so what are we told? What are we told? That is the question number 2. So the question is, Lock Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred what? Consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. Lock Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, Lock Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶 Limited, a public limited entity, public limited entity. Effectively, Rock Limited purchased 50% of the equity shares of 𝐶𝐶 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, Lock, Paper, and 𝐶𝐶. We have the statement of financial position for the 3 companies, that is Lock, Paper, and 𝐶𝐶. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called Lock Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Paper, a public limited company, on 1st April 2024. So the company which is called Lock Limited, this company acquired 80% equity shareholding in a company which is called Paper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that Lock is the parent and then Paper is the subsidiary. You can see also we're given the date of acquisition. Then from there, once we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, Lock Limited, our parent company, with another entity, entered into a joint arrangement to jointly control 𝐶𝐶 Limited, a public limited entity. Effectively, Lock Limited purchased 50% of the equity shares of what? Of 𝐶𝐶 for an immediate cash payment of 15. So this company here, we are told, acquired 50% shareholding in a company which is called 𝐶𝐶 Limited. 𝐶𝐶 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one would be a joint what? A joint venture. So that is the first thing you always need to have because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of a financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of CSAS. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalue the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you'll come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we said in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. Other charge, and equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There's a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have, from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what? Year. We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told LOC Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, That information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCH fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiaries are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, amount of unreleased profit. So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unreleased profit, and this unreleased profit is always by the selling company. The selling company is this one. So this is unreleased profit by Paper. So how do we compute this unreleased profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods would be half of the goods which were sold by Paper to Rock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20% as a fraction. As a fraction, it will be equal to what? As a fraction. As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1 over 5. So this one will be, the margin will be 1 over 5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the 3 adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, that point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, that is, because the amount of money which Lock Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically reveals that both goodwill on acquisition and on paper limited and the interest in Caesar were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, you said we only compute the goodwill on acquisition of the subsidiary and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company that is paper, paper limited, as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have two columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in two forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, and as a non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 1331 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and local limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331, and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1, remember the formula here, 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. plus pre-acquisition reserve. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically what we know is that that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI, parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 51 what? 80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what do we need to do? Can we go to the income statement, the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax? The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year added on 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in CSAS, which is 50%. That gives us now the group share of CSAS limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always a 3 mark. No single question for group accounts will come across whereby the distribution cost is to be adjusted. This is always a 3 mark. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting 13? Yes. So then below that, we have the administrative expenses. Administrative expenses, we take that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation added charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company will have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. We did come to 121. Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a 3 mark. Income tax expense. Income tax expense, also this one, is always a 3 mark. A 3 mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320. Yes. So basically in our case we are done, and that what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE, and then this depreciation other charge of 70 will be deducted from the PPE. 2 adjustments here. 2 adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in CSAS. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of CSAS and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320. In relation to CSAS, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid or the cost of investment. That is basically what we have within the statement of financial or within the statement of financial position of the parent under the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year, Sisters was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, you are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include here. Then from there we proceed and basically we record the current asset. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we say should be deducted from the group inventory. Inventory is part of this. So we less and there is profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total asset in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to recall your total in a part. These are some of the items you don't have to compute in an exam. They'll consume a lot of your time and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to record that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here, that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper, paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Yes. That's basically how we compute that. So what basically we should do is to have 3 columns for our companies here, starting with the parent, which is log, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we're given the retained earnings of log, that 380. For paper, it is given as what? 1,800, and for sisters is given as what? Is given as 12. So the first thing we need to do for these 2 companies, we are interested with the post-acquisition. So what we need to do for these 2 companies is to less the pre-acquisition. What? Acquisition. That does not apply to the parent. It only applies to these 2 companies. Yes. And I think for this, what we will do, for this company, I think we computed we computed for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something we have already computed. Who can give me that figure? That retained earnings in tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition here need 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the scissors? Scissors, when was it acquired? I hope you can remember when scissors was acquired. Scissors was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year. 6 months to the end of the year. Basically, for scissors, we need to have, first of all, its retained earnings at the end. Its retained earnings at the end for scissors is 12, the value which we have here. Let's be together here. And then we also need to have the profit for scissors for the year. That one, we get it from the income statement. From the income statement, the profit for the year for scissors is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of scissors on this date of it was acquired? Just like how we computed this. It's quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 all over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of scissors at the start, which you have said is this, minus this, which will give us 560. And then for me to compute its retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and track value, what do we get here? We get what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. There are some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this unreleased profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have unreleased profit that will also be deducted from the retained earnings of paper, 50, like that, like that. Do we have any other adjustment? I can't see any other. So we need to get the final figures, that is 380, this one 2400, this is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent, we take 100. For paper, we take 80. And for this company that is the sisters, we take 50. we take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those three values. We add those three values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 38.60. Basically, you can see how the computation for this is quite demanding. And that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 3860, which basically give us 9360. Finally, we compute the NCI. So the NCI is what? We'll talk about the NCI. Basically, this refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end? To be recognized there as a component of equity. Now, to compute this, very simple. We take the NCI at fair value. The NCI at fair value, which is basically given in note 2. The NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share law, the post, that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary, which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we less here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No item to be deducted there. So we add these two values and then give us 9 what? 940. So the NCI fair value here is basically 940. But basically I'm saying if, although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this, because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing. That is what I'm told. What is the difference? What have you omitted? Ten. Or 10 bob. Ten bob. 10 bob is, how do we have that? Where do we have that 10 bob? Yes, I think it is. That one should be. Is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is there. What is the difference? Is the difference is it 110? 110? Yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration, it should be deducted from the retained earnings of the parent. Deduct that here. Deduct that here. It was supposed to be accounted for as an expense by the parent, but the parent company had not accounted for that in the income statement. Was it accounted for by the parent company? No. So that's why it should be deducted there. 33, 80 minus 110. So now this one should be 92, 70. And the retained earnings should be 30, 37, 50. Yes, it should now balance. It should now balance. It should now balance. Is it not balancing? Yes, it should balance. So I think that is what you have forgotten here. Because remember, this is an expense which the parent company was supposed to have accounted for. The parent company needed to recognize this as an expense. And that's what you can see in the income statement. The parent company didn't have a finance cost. That was supposed to be captured here. And therefore, even the profit which you have taken into account here, that was supposed to have been deducted. And because it was not deducted, that's why we're deducting it here. Sasa, yes. So basically, this is what was required as far as that question is concerned. And I'm saying this is one of the easiest questions which has ever been tested in advanced financial reporting in relation to the group account. In relation to the group what? Account. And there is a question which I'll give you there as an assignment. You attempt it. Because now what I want us to do once we meet in our next class, we are looking now on special cases in group accounts. We will start by looking on the aspect of piecemeal acquisition. We do a question, just a small discussion, and then we do a question. In our next class, that is what we will do. That is on Tuesday. Then on Wednesday, we will be able to look on how we account for the disposal of interest. And then on Saturday, we do foreign subsidiaries. So basically, we should be done with this next week. What we will be remaining with is the group cash flow. Is the group what? Cash flow. So because we have those three concepts which are remaining: piecemeal acquisition, the disposal of interest, and the foreign subsidiary. We will be able to take one class each, but basically we will be able to come back and look on this during our revision. So the question I want you to attempt is the question for December. The question for December 2022, which basically is question number 3. Question number 3. I want you to attempt this one. Maybe during our revision, we will be able to look on it. We will be able to look on that. We will be able to look on this. We will be able to look on this. Remember, what we said is that if everything goes on well, we should be done at least with this by next week, our first class. And then from there, I think what will be remaining is maybe the theories and maybe like the financial statement of the insurance company. Right now, we can say that we are almost like over 85% done with the syllabus. So I'm hoping that if everything goes on well, we should be done with this by next week. Next week, but one on Tuesday. On what Tuesday? So let's stop at that point for today. You have a nice weekend and make sure you attempt that particular question. In case you come across any challenge, you can maybe get some assistance from me. Equally, if you're able to attempt the question, you can send it to me. I'll be able to check on it and give you the feedback. Sasa, yes, we stop at that point. Have a nice weekend. See you next week on Tuesday. and the insurance company undertakes to compensate the insured on the happening of a future uncertain event, and this person on his part must be paying some periodical payments which are known as what? The premiums. Now, these insurance companies usually provide various types of insurance businesses, and those insurance businesses are usually classified into two. So mean that we have two types of insurance business. Majorly we have two, or they are classified into two. We have life insurance. And when we talk about life insurance, this is a type of an insurance contract whereby the insurance company basically undertakes to compensate, or basically to pay the insured a certain amount of money, which is known as a lump sum, upon the insured attaining a certain age, or basically upon his death, whichever occurs earlier. So in this case now, a lump sum will have to be paid to the insured either upon attaining a certain age, or basically upon his death, whichever will occur earlier. Then from there we have now the general insurance. So when we talk about the general insurance, this refers to any other insurance business other than the life insurance, insurance or the life assurance. And therefore, the general insurance, this includes insurance businesses such as burglary insurance. You have a business, you insure your business against theft. We have the fire insurance, we have the motor vehicle insurance, we have the marine insurance, and so on. So all those types of insurance business, they fall under what you call the general insurance. So now the insurance companies, or basically those particular companies which undertake insurance business, at the end of each year, they are expected to prepare financial statement. And the financial statement prepared by these insurance companies include: number one, we have the revenue account. Number two, we have the general statement of a profit or loss, or basically the income statement. And number three, we have the statement of financial position. So let's start by looking on what we mean by the revenue account. The revenue account. Now, the revenue account, basically, this is an account which is prepared to determine the performance of each insurance business. Assuming we have an insurance company which is maybe providing two insurance business, the life insurance and maybe the fire insurance. So those are two different insurance business. So the insurance company would like to know at the end of each year, how is each insurance business performing? So such an insurance company will prepare something called the revenue account. So therefore, this is basically prepared. This one is prepared to do what? To determine the financial performance of each insurance business. So how do we prepare this particular account here? I want us to look on the format, and then I will be able to explain how we compute a number of items. So this particular account is basically prepared using a vertical format, not the T format. So the revenue account. So assuming our insurance company basically undertake two insurance business, maybe like the fire insurance, or provide two insurance business, the fire insurance, and maybe the life insurance. So basically in that case, we have two columns here. And when preparing this, always we start with the incomes, or basically the revenue from each insurance business, business. So the first, or basically what we know is that once you have insured a certain subject matter, you have to pay something called a premium to your insurance company. So this premium is one main source of income as far as these insurance businesses are concerned, the net premium. But in this case, we are going to look on how we compute this. Maybe we will have working one. Basically, we look on how do we compute the net premium, because that is something which the examiner will not have given you. You have to compute that. And then out to this, and basically what we know is that if, for example, you have insured a certain subject matter, you pay the premium in advance. For example, you own a car, you have insured your car, you pay the premium in advance. Some insurance companies may tell you, can you pay this in 2 installments? So, but you pay the premium in advance. So therefore, we know that that premium which you are paying basically covers or basically the insurance cover for the next 1 year. For the next 1 year. So basically, much of the money collected by the insurance company or much of the revenue is received in advance. Now, this premium is only supposed to be recognized as an income by the insurance company once the period covered has expired. For example, if the insurance company has received premium of 1 billion, it covers the next 2 years. So that premium will only be deemed to have to be earned as an income once the 2 years are over, or basically 1 year is is what? Is over. So therefore, you may see that out of these particular premiums which were received during the current year, you may be told that part of it was not yet earned because the period covered has not done what? Expired. So what do we do to this particular net premium? We basically add the unearned premium and earned premium balance brought down. So these are the premiums which were not yet earned in the previous year because the period covered was not expired. Automatically, the period covered by those premiums will expire during the current year because usually the premium you pay is for 1 year. So any premium which was not yet earned in the previous year because the period covered had not expired will be earned during this year. So therefore, these are the unearned premium from the previous year. And then to this we less the unearned premium, balance carried down, balance carried down. So these are basically the premiums which were received during the current year. These premiums which were received during the current year, but because the period covered has not expired, they have not yet been earned. So they should be deducted from this. And then out to this, we add something known as the commission on reinsurance, ceded. Also, I'll be able to explain something to do with that. Let's just put it as a note there. Yes, I'll be able to give a note for that. I'll also be able to give a note for that. So, and then we get the total here. We proceed and we lessen out the expenses. And the expenses which we left here are basically the expenses specifically relating to its insurance business because they are general expenses. The general expenses to the insurance company, we take them here to the general income statement. But basically what we record here and the specific expenses relating to each insurance business. For example, in this case, you may be given some legal costs associated with each insurance business. We may also be given budgets which were written off. Budgets written off, these are maybe the premiums which the customers decline to pay. We may also be given the management fee for each insurance business. We also have something called the net claims. In fact, this is basically the main expense for each insurance business. So once we have various individuals who have insured their subject matter with the insurance companies. So, and maybe the event insured against have occurred, they go to the insurance company, they raise a claim. You have insured your car, you have taken a comprehensive insurance cover, your car is involved in an accident, you raise a claim with the insurance company. So once you are paid by insurance company, that is an expense relating to that insurance business. So we are going to look on how we compute this. We will have a note on that, note 3. Yes. So, and then also there is something else here we should not forget, known as commission on reinsurance accepted. Commission on reinsurance accepted. I'll also be able to give a note for that. What do you mean by that? Yes. And basically we less all those particular expenses from our total revenue here, and basically we get something called the net income. The net income from each insurance business. The net income is basically the profit from each insurance business. So this is basically how we prepare the revenue account for each insurance business. So I think before you look on how we prepare the general income statement, maybe I can just give explain some of these items. Like one, the net premium. So how do we compute the net premium? Which will be taken to the revenue account? So we can say this is basically computed by preparing premium account. Remember, premium is basically what you pay as a person who has taken an insurance cover. So to the insurance company, this is the amount they receive. So how do we prepare this account, the premium account? So, and also assuming our insurance business is providing to insurance business, is involved into insurance business, that is basically fire and the fire and life insurance. Fire and life, we have two columns on both the debit and the credit side, the fire and life insurance. So in most of the cases, you'll be told that some of the customers or some of the clients have not paid their premium. So if you have not paid your premium to an insurance company, you have not cleared your premium to the insurance company is an asset. So therefore, you'll be given the premiums outstanding at the start, which basically we record here as an asset. The premiums which were outstanding at the end of the year, at the end of the year, simply because it's an asset. Premium which you have not paid is what? Is basically an asset. Then you will also be given the premiums which were received. Premiums which were received. So an insurance company can receive premium either from the client directly, from the stockbrokers, and so on. So therefore, the premiums which were received, the double entry, we follow the double entry, is debited in the bank and then credited in this account. So the premium which was received. And this premium can be received either from the client of share, the issue of debenture, acquisition of bank loan, and maybe the redemption of debentures which have been issued by the company, and so on. And then after classifying the activities into those three categories, in preparation of the statement of cash flows, we have to determine the net cash flows from each of these three activities, basically in that order. We determine the net cash flows of a company in that order. How do we determine this particular net cash flow? So to determine this, we take the cash inflow. Basically, when we talk about the cash inflow, this refers to any money which is flowing into the business. Like once the company sells an asset, the company receives money. Once the company issues shares or basically debentures, the company receives money. So the money which is received or money coming into the business, we basically refer to that as a cash inflow. The other rule is that when preparing the statement of cash flow, any amount which is a cash inflow, we record it in our statement of cash flow as a positive. As what? As a positive. So we take the cash inflows, and then to this we less the cash what? The cash outflows. So